U.S. Treasury auction fails. Bid to cover ratio 1.8. Worst since 2008. Indirect bidders 32%. 10-year below trend. Foreign reserve managers selling. Not buying. Dollar funding spread spike. Enforcement action somewhere triggered it. Venezuela or Taiwan or Iran. Doesn't matter which. Pattern matters. This happened before. Britain. Empire power. Reserve currency. Took enforcement action. Markets attacked the currency. Reserve holders sold. $700 million. Gone in 2 weeks. 25% of reserves. Britain forced to choose. Empire or currency. Chose currency. Withdrew from Suez. Superpower status ended. Not with battle loss. With bond market discipline. Same pattern. Different currency. Same ending. Welcome to Financial Rewind. I'm here to show you how empires end. Not with explosions. With funding constraints. And today, we're examining Britain's 1956 Suez Crisis. As warning label for the dollar empire, because when reserve currency meets enforcement costs, markets decide who wins, not generals. And 1956 proved, markets always win. This is the parallel they don't teach. Let's begin. Late October 1956, the week the market voted, British and French forces invade Egypt. Objective? Retake Suez Canal. Nasser nationalized it 3 months prior. Western powers respond with force. Operation launches October 31st. Military success immediate. Port Said captured. Canal secured. Victory looks complete. But something else happens. Simultaneously. In currency markets, sterling falls. British pound supposed to be stable. Fixed exchange rate system. Pegged at $2.80. Should hold. Doesn't. Reserve holders dump pounds. For dollars. For gold. For anything else. Bank of England forced to intervene. Sells dollar reserves. To defend the peg. Losses mount. 50 million pounds worth. Then 100 million. Then more. Accelerating. President Eisenhower watches. Makes calculation. Applies pressure. Not diplomatic. Monetary. Blocks Britain's IMF access. Until they withdraw from Suez. The signal is clear. No bailout. No support. Isolated. Markets interpret correctly. Britain vulnerable. Sterling at risk. Selling intensifies. November 6th. Britain capitulates. Ceasefire announced. Withdrawal begins immediately. Not because Egypt won militarily, because Britain couldn't defend pound in Suez. Simultaneously, government chose currency over empire, reserves over territory, financial stability over strategic objectives. This is the moment Britain stopped being superpower, decided by bondholders, not by generals. Because when you're reserve currency under funding stress, markets control your foreign policy, and the market voted no. Let's trace the timeline. Contemporary accounts describe the sequence. July 26th, 1956. Gamal Abdel Nasser, President of Egypt, nationalizes Suez Canal. Public speech in Alexandria. Canal now Egyptian property. Effective immediately. Britain and France outraged. Canal operated by British-French consortium since 1869. Carries 2/3 of Europe's oil. Strategic choke point for global trade. Nasser's move calculated. Challenges Western control directly. Tests their resolve. August through October, diplomatic negotiations fail. Britain and France plan military response. Coordinate secretly with Israel. Protocol signed October 24th at Sèvres. 3-party agreement. Israel invades Sinai October 29th. Provides pretext. Britain and France issue ultimatum. Both sides withdraw from Canal Zone. Egypt refuses. October 31st. British and French bombing begins. November 5th. Paratroopers land at Port Said. Egyptian forces retreat. Military objectives achieved. Canal secured. Victory complete. On the battlefield, but financial front collapsing. Sterling under immediate pressure. Fixed exchange rate system. Pound pegged at $2.80. Bank of England obligated to defend. Must sell dollar reserves. To meet selling pressure. Reserve losses documented in bank records. $2,700 million. End of September. $2,000 million. Mid-November. $700 million gone. In 6 weeks. 25% of total reserves. That's the number that mattered. Not troop counts. Not casualties. Reserve depletion. Because reserves measure confidence. And confidence was breaking. Here's the mechanism. Britain runs current account deficit. Imports exceed exports. Needs foreign capital inflows. To fund the gap. Normally receives it. Sterling is reserve currency. Second only to dollar. Trusted globally. Until Suez. Suddenly perception shifts. Reserve holders see Britain taking military action against American wishes, diplomatically isolated. Reserves bleeding fast. Risk calculation changes. Why hold pounds when dollars safer? Under stress. Capital flows reverse. Instead of inflows, Britain experiences outflows. Reserve drain doubles. Current account deficit plus capital flight. Simultaneously, unsustainable combination. Eisenhower recognizes opportunity, applies financial leverage. Britain needs IMF support. $1.3 billion standby credit. To stabilize reserves, signal market confidence. Stop the bleeding. Eisenhower blocks it. Condition explicit. Withdraw from Suez first. Then support. Not before. Britain applies November 30th. Denied pending withdrawal. December 3rd. Britain announces complete withdrawal. December 10th. IMF approves standby credit. $1.3 billion. Britain never draws it. Didn't need to. Approval itself was signal. Market stabilized. Selling pressure eased. Reserves stopped bleeding. The IMF credit functioned as confidence restoration. Not actual funding, just the knowledge. That support existed was enough. Crisis over. But damage done. Britain proved cannot sustain empire. And reserve currency? Under market stress. Had to choose. Chose currency. Empire finished. This is the mechanism that matters. Not tanks. Not bombs. Confidence. And confidence, once broken, doesn't return because you ask nicely. Let me show you the mechanism. How empires lose policy freedom when markets lose confidence. Step 1. Empire takes action. Military enforcement. Strategic operation. Necessary from empire's view. Step 2. Action costs money. Troops. Equipment. Logistics. But also opportunity cost. Markets reassess risk. Step 3. Reserve holders notice. Empire under stress. Spending reserves. Taking risks. Maybe currency less safe than previously thought. Step 4. Selling begins. Small at first, then accelerates. Herd behavior. Everyone exits simultaneously. Step 5. Central bank defends. Must maintain peg. Sells reserves. Buys own currency. Stemming outflow. Step 6. Reserves deplete. Faster than expected. Market sees depletion. Sells more. Doom loop. Step 7. Empire faces choice. Continue operation. Lose currency stability. Or abandon operation. Save currency. No middle option. Step 8. Empire chooses currency. Always. Because currency is foundation. Of everything else, lose currency, lose ability to fund anything, lose empire entirely. Step 9. Operation abandoned. Withdrawal announced. Strategic objectives forfeit. Step 10. Market discipline complete. Bondholders controlled foreign policy. Empire constrained. By funding requirements, not military capacity. This is the pattern. Played out in 1956. Britain learned it the hard way. Question is, does America remember? Or will 2027 teach the same lesson, with different currency? 5 warning signs from 1956. Package them as warning labels. For future empires, warning 1. Fixed commitments under flexible confidence. Britain had fixed exchange rate, required defending specific level, but confidence is flexible, can evaporate quickly. Mismatch is fatal. Modern parallel. Dollar has fixed commitments too. Treasury auctions on schedule. Debt rollovers required. Funding needs non-negotiable. But foreign demand is flexible. Can disappear. Same mismatch. Different mechanism. Warning 2. Reserve depletion is confidence depletion. Britain lost 25% reserves. In 6 weeks, each billion lost. Signaled less capacity to defend. Created more selling. Self-reinforcing. Modern parallel foreign treasury holdings. 8 trillion currently. If falls to 6 trillion, 25% decline. Same signal, less foreign support. More pressure, same doom loop. Warning 3. Enforcement costs credibility. Suez wasn't expensive militarily. Few £100 million. Britain could afford it. Financially, but enforcement revealed willingness to prioritize. Strategic objectives over market confidence. That revelation cost everything. Modern parallel, any enforcement action. Venezuela extraction. Taiwan intervention. Iran strike. Cost isn't the operation. Cost is the signal. That geopolitics outweighs market stability. In priority, that signal triggers selling. Warning 4. Allies can become enforcers. Eisenhower blocked IMF support. America was Britain's ally. Security partner. but saw opportunity, applied financial pressure, achieved strategic objective without firing shot. Modern parallel. Who enforces against America? China holds treasuries. Japan holds treasuries. Saudi Arabia holds treasuries. All could sell. Simultaneously, if interests diverge from U.S. policy, allies become enforcers. Through bond markets. Warning 5. The IMF credit that wasn't needed. Britain got $1.3 billion standby. Never drew it. Approval was enough. Signal restored confidence. Selling stopped. But here's the lesson. Needed external validation. To restore trust. Couldn't do it alone. Modern parallel. Who validates dollar? IMF can't. America is IMF. No higher authority. No external backstop. If dollar confidence breaks, no institution large enough. To restore it, this is the difference. Britain had escape hatch. Dollar doesn't. These 5 warnings apply today. With modifications, but pattern identical. And pattern suggests constraint is coming for dollar empire, just like sterling empire. In 1956, now the rhyme with 2027. Why modern reserve system still faces constraint, despite differences. First difference, dollar is floating, not fixed like 1,956 sterling. No peg to defend. This seems safer, but creates different vulnerability. Floating means devaluation is option, but devaluation. Against what? If dollar falls, import prices rise. Inflation accelerates. Fed must choose. Defend dollar through rate hikes. Or accept inflation. Both are constraint. Different type. Same result. Second difference, America is larger economy. Britain was 5% global GDP in 1956. America is 25% today. 5 times larger share. This seems like strength, but creates obligation. Larger economy means larger funding needs. 36 trillion debt. 1 trillion annual interest. Must be funded continuously. Size is vulnerability, not strength. Third difference, dollar has no alternative. In 1956, dollar existed as alternative to sterling. Reserve managers could switch. Today, what's alternative to dollar? Euro fragmented. Yuan restricted. Gold insufficient volume. No clear substitute. This seems like protection, but creates complacency. Assuming dollar irreplaceable is dangerous because alternatives emerge. When needed, BRICS building systems, Enbridge processing transactions, digital yuan scaling, gold accumulation by central banks, not replacing dollar, but reducing dependence. Death by 1,000 cuts, not sudden collapse. Fourth vulnerability, weaponization memory. Dollar has been weaponized. Russia sanctions 2022. Reserves frozen. SWIFT access cut. Iran sanctions decades long. Venezuela sanctions ongoing. Every use of financial weapon creates incentive for others to exit. Before they're targeted, this is new vulnerability. Britain never weaponized sterling. Same way, dollar weaponization accelerates diversification, even without crisis. Fifth vulnerability, enforcement costs rising. America's strategic commitments. Larger than Britain's 1,956. NATO, Indo-Pacific allies, Middle East presence, global enforcement capacity. All costs money, all requires funding, all creates potential for market discipline. If enforcement action conflicts with market stability, same choice Britain faced. Now facing America, the rhyme isn't perfect. Mechanisms differ, but pattern identical. Reserve currency, plus enforcement costs, plus confidence, stress, equals constraint. Britain learned 1,956. Question is timing for America, and the answer might be 2027. What does Suez moment look like? In 2020 seconds, 3 archetypes, not predictions. Possibilities. Archetype 1, energy choke point enforcement. Similar to Suez, Strait of Hormuz. Iran threatens closure. 20% of oil flows through. U.S. responds militarily. Reopens strait. But operation costs. Treasury auction that week. Fails to clear. Bid to cover below 2. Foreign buyers absent. Risk premium appears. 10-year yield spikes. 150 basis points. Overnight. Fed must intervene. Buy treasuries directly. Signal is sent. America can't fund. Enforcement and debt. Simultaneously, without Fed monetization, markets reassess. Dollar weakens. Gold spikes. Archetype 2. Sanctions blowback. U.S. imposes sanctions. On major economy, China over Taiwan. or Saudi Arabia over oil policy. Freezes reserves, cuts SWIFT access, target retaliates, dumps treasuries, 500 billion. In 1 month, other reserve holders see the precedent, realize their holdings, also vulnerable, begin diversifying. Preemptively, Treasury demand collapses. Auction fails, yields spike, funding crisis. Fed intervenes again, buys treasuries, prints money. Inflation accelerates. Archetype 3, cascading funding shock. Starts small, regional bank crisis, or commercial real estate. Fed provides liquidity, expands balance sheet, inflation upticks. Fed forced to hike, despite fragility, higher rates stress system, more failures, more intervention, more inflation. Cycle accelerates. Foreign reserve managers, watch Fed trapped. Between inflation and stability, lose confidence, begin selling treasuries. Slowly at first, then rapidly, doom loop. Same as Britain, 1956. Different trigger, same mechanism. None of these are predictions. All are possibilities, based on observable incentive structures and historical rhyme. The trigger doesn't matter, pattern matters. Enforcement or crisis, meets funding constraint, meets confidence break, results in discipline. By markets, not choice, constraint. Let me show you the modern doom loop, step by step. Easy to visualize. Step 1, trigger event, geopolitical enforcement, or financial crisis, or inflation shock, doesn't matter which, creates stress. Step 2, Treasury auction weakness, foreign buyers reduce, bid to cover falls, tails widen, indirect participation drops, below 35%. Signal is visible. Step 3, dollar funding spreads spike, cross-currency basis, SO for base spreads, repo market stress, all widen simultaneously, indicates funding tightness. Step 4, Fed intervenes, announces Treasury purchases, or swap line expansion, or emergency facilities, provides liquidity, stabilizes short term. Step 5, intervention creates inflation concern, balance sheet expands, money supply grows, markets price inflation, break-evens rise, gold rallies. Step 6, foreign reserve managers reassess, watch Fed monetizing, watch inflation rising, real returns on treasuries turning negative. Why hold depreciating asset? Step 7, reserve diversification accelerates, selling begins, not panic, gradual but persistent. 100 billion quarter, then 150, then 200, accelerating. Step 8, Treasury yields spike despite Fed buying. Markets overwhelm intervention. 10-year breaks 5%, then 5.5, then 6. Fed buying more. Can't stop rise. Step 9, funding costs become unsustainable. Interest on debt exceeds 1.5 trillion. 20% of federal budget, just interest. Not principal, not programs. Unsustainable. Step 10, policy constraint achieved. Government must cut spending, or raise taxes, or accept hyperinflation. No good options. Markets dictating policy. Same as Britain, 1956. Different currency. Same constraint. This is the doom loop. Once triggered, hard to stop, because each intervention creates next problem. Self-reinforcing until constraint. Forces choice. 3 conditional futures, based on how stress unfolds. First future, managed adjustment. Trigger is moderate, regional crisis, or medium-sized enforcement action. Treasury auctions weaken but don't fail. Bid to cover drops to 2.1, still clearing. Foreign participation declines to 38%, down from 45. Noticeable but not catastrophic. Fed intervenes modestly, buys 200 billion over 6 months, stabilizes market, but signals new regime. Markets understand. Fed is implicit backstop. For Treasury market, adjustment occurs gradually. Dollar share of reserves declines from 58 to 53%. Over 3 years, manageable pace, Treasury yields rise to 4.8% 10-year, from 80 basis points. Higher funding costs, but sustainable. Government adjusts policy, modestly, reduces some commitments, raises some revenues, slows deficit growth. Not elimination, improvement, outcome. Dollar remains dominant reserve, but with constraints visible. Policy, freedom reduced, but not eliminated. Empire adjusts. Doesn't collapse. Gradual decline. Over decade. Second future. Fragmentation acceleration. Trigger is major. Taiwan conflict. Or large-scale sanctions. or significant enforcement. Treasury auction fails outright. Bid to cover 1.7. Worst since 2008. Foreign participation 28%. Lowest in decades. Fed forced to intervene massively. $500 billion announced. Immediate purchases. Stabilizes auction. But markets see monetization as primary mechanism. No longer last resort. Confidence breaks. Foreign reserve diversification. Accelerates dramatically. Dollar share falls. 58 to 48%. In 18 months, 10 percentage point drop. Fastest in history. Gold surges. 3,000 to 5,000. Yuan reserves double. Bitcoin rallies. Alternative systems scale. M-Bridge processing 50 billion monthly. BRICS Pay adoption accelerates. Oil increasingly traded. Outside dollars. Bifurcated system emerges. Dollar block versus alternative block. Treasury yields spike. 6.5% 10-year, despite Fed buying. Inflation rises. 7%. Despite recession, Fed trapped. Stagflation returns. Government forced to cut spending. 20% across board. No choice. Markets demanding. Fiscal discipline. Outcome, dollar remains important, but no longer dominant. Multipolar reserve system. U.S. Policy heavily constrained. Empire contracted. Visibly. Quickly. Third future. Funding crisis cascade. Trigger is systemic. Multiple crises converge. Geopolitical plus financial. Plus inflation shock. Simultaneously, Treasury auction fails completely. Bid to cover 1.4. Foreign participation 18%. Historic low. Fed announces unlimited purchases. Whatever it takes. Markets revolt. Dollar crashes. 20% in 3 months. Against basket. Import prices explode. Inflation hits double digits. Fed faces impossible choice. Defend dollar through rate hikes. Crash the economy. Or accept hyperinflation. Chooses neither. Tries middle path. Fails. Reserve flight accelerates. Dollar share collapses. 58 to 38%. In 12 months, Treasury market breaks. Yields hit 9%. Despite Fed buying, real yields deeply negative. Government funding impossible. At sustainable rates, emergency measures. Capital controls discussed. Gold confiscation considered. Desperate moves. Social instability. As inflation destroys, purchasing power. Political crisis follows. Outcome. Dollar loses reserve status. Within 36 months. Replaced by basket. SDR-style system. Or gold-backed alternative. U.S. Standard of living. Contracts 30%. Import costs double. Empire ends. Not gradually. Rapidly. These aren't predictions. They're pathways. Based on stress triggers and historical patterns. Which pathway unfolds depends on decisions made in moments of crisis and how markets respond to those decisions. What to watch? 5 indicators. Track these closely. Indicator 1, Treasury auction quality metrics. Bid to cover ratio, healthy above 2.5. Concerning below 2.2. Critical below 2. Watch trend, not single auction. Indirect bidder participation, foreign central banks and reserve managers. Healthy above 42%. Concerning below 38%. Critical below 35%. Auction tails. Difference between high yield and expected. Healthy below 2 basis points. Concerning above 3. Critical above 5. Check every auction. Weekly for short term. Monthly for long term. Indicator 2. Dollar funding stress signals. Cross-currency basis swaps. Dollar euro. Dollar yen. Normal range minus 10 to plus 10 basis points. Stress is plus 25 or more. Crisis is plus 50. SOFR spreads. Secured overnight financing rate. Normal 4.5 to 5%. Stress is 5.5. Crisis is 6 plus. Fed swap line usage. Available on Fed website weekly. Normal is minimal usage. Stress is 50 billion plus. Crisis is 100 billion plus. Monitor weekly. Indicator 3. Reserve composition trends. Dollar share of allocated reserves. IMF COFR data quarterly. Currently 58%. Watch for decline. Below 55 is significant. Below 50 is critical. Not single quarter. Trend over 4 quarters. Central bank gold purchases. World Gold Council data monthly. Normal is 30 to 50 tons monthly. Elevated is 75 plus. Crisis is 125 plus. Sustained elevated purchases. Signal diversification. Check quarterly for reserves. Monthly for gold. Indicator 4. oil market enforcement premium, shipping insurance rates, Lloyd's war risk premiums, Venezuelan routes, Iranian routes, Hormuz related. If premiums spike, indicates enforcement risk, rising, benchmark spreads, Brent WTI, Brent Dubai, heavy light differentials. If widened beyond historical ranges, indicates supply stress or route disruption. Monitor weekly. Indicator 5, inflation break-even spreads, 10-year break-even, tips versus nominal, normal 2 to 2.5%, elevated 2.7 to 3, crisis 3.5 plus, 5-year forward. Fed's preferred inflation expectation measure, normal 2 to 2.3, elevated 2.5, crisis 3 plus. If break-even spike while Fed buying treasuries, markets pricing, monetization, inflation, check daily. These 5 indicators show stress building before crisis visible. Plumbing moves first. Headlines move last. Watch the plumbing. Let me bring this home. The target in 1956 wasn't Suez Canal. The target was British power. And the weapon wasn't tanks. It was currency markets. Eisenhower understood. He didn't need military force. Didn't need threats. Just needed to step back. Let markets discipline Britain. Sterling did the rest. 700 million in reserves. 25% of total. Gone in weeks. Britain capitulated. Withdrew from Suez. Not because they lost militarily. Because they couldn't defend. Currency and empire. Simultaneously. This is the pattern. Empires don't fall because they lose battles. They fall because they lose monetary trust. And monetary trust, once broken, doesn't return because you ask nicely. Returns when you prove you've changed through discipline, through constraint, through sacrifice. Britain proved it by abandoning empire to save the pound. Question for 2027. What will America sacrifice to save the dollar? Global commitments? Enforcement actions? Strategic objectives? Or will America believe? Dollar is different, too big to discipline, too important to fail. That belief is dangerous because Britain believed it too. In 1956, about sterling, and the market proved them wrong. In 2 weeks, 2 questions for you. Drop answers in comments. Question 1. If 2027 brings a Suez moment, what gets sacrificed first? Military commitments? Enforcement actions? Or dollar stability? Which would you choose? If you were president, question 2. Can a reserve currency be too big to fail? Or does size increase vulnerability? By increasing funding needs. Leave your analysis below, because this isn't theory. This is pattern recognition, and patterns repeat until lessons learned. Final thought. The warning from 1956 isn't about Suez, isn't about Britain, isn't even about empires. The warning is about discipline, markets discipline, governments that overextend, currencies that overcommit, empires that overpromise. Britain learned in 1956 through reserve depletion, financial constraint, strategic retreat. America might learn in 2027, but the mechanism will differ. Won't be reserves depleting, will be auctions failing, won't be fixed peg breaking, will be funding costs spiking, won't be IMF stepping in, will be Fed monetizing. Different mechanics, same constraint, same result. Markets win. Governments adjust or collapse. If you want to see what happens next, subscribe. Hit the bell, because 1956 showed the pattern. 2027 might show the repeat, and the repeat won't announce itself with headlines. Will announce itself in auction results, in funding spreads, in reserve data you won't see on news until it's already priced. Thanks for watching Financial Rewind. I'll see you in the next one, where we trace how funding constraints become foreign policy and why the next empire will remember what Britain forgot until it was too late. Suez didn't end with tanks. It ended with the currency. And if 2027 rhymes, it won't look like a collapse. It will look like constraint.